Hi, everyone. My name is James. Welcome to this channel, and thank you for joining this session on auditing credit risk focus areas. Whether you're an internal auditor, a risk manager, or a finance professional, understanding how to effectively audit credit risk is crucial for the health and stability of any financial institution. Today, we won't just be talking about checking boxes. We will explore a strategic approach to auditing the entire credit lifecycle, from the moment a customer applies for a loan to the final recovery if it fails. Our goal is to move beyond basic compliance and provide assurance that the organization is not only following its rules, but is also effectively managing its single largest risk. Let's break down this complex process into four key parts. First, we'll set the stage with governance and the audit universe. Second, we'll dive deep into the pre-approval phase, underwriting, and origination. Third, we'll examine the post-approval world of portfolio monitoring. And finally, we'll tackle the critical area of problem credit management. We'll conclude with key takeaways to help you strengthen your own audit plans, the foundation, governance, and strategy. Before we look at a single loan file, we must start at the top. A weak foundation of governance makes even the most perfect-looking loan files risky. So, what are our key focus areas here? First, the tone at the top. We need to ask, has the board of directors defined a clear and measurable credit risk appetite? Is it just a paragraph in a dusty document? Or is it a living, breathing framework that is communicated, understood, and used to make daily decisions? As auditors, we look for evidence that this appetite is integrated into business strategies and lending limits. Second, policies and procedures. Are the credit risk policies comprehensive and up to date? Do they clearly define roles, responsibilities, and approval authorities? We must verify that these policies are not just on a shelf, but are actively being used by the underwriters and relationship managers. And third, organizational structure. This is about segregation of duties. Is there a clear and independent line between the people who sell the loans, the people who approve them, and the people who collect them? A lack of independence here is a classic red flag for potential credit quality issues and even fraud. Supporting this governance is the risk management framework. Here, we focus on three key enablers. 1. Data integrity. Garbage in, garbage out. The entire credit decisioning process relies on accurate and complete data. Our audit must assess the controls over key data inputs, from customer information to financial statements. 2. Models. Many institutions use credit scoring models or internal rating systems. Our job is to ask, have these models been independently validated? Are they performing as intended? And critically, are overrides of these models properly documented, justified, and monitored? A high override rate can indicate a broken model or undue pressure from the business. 3. Stress testing and reporting. Does management receive timely and accurate reports on the credit portfolio? Are stress tests performed to see how the portfolio would weather an economic downturn? We need to see that the institution isn't just driving by, looking in the rearview mirror. Now, let's move to the front lines, the underwriting and origination process. This is the organization's first and best chance to keep risk out. A failure here is often where future problems are born. Our audit here is a deep dive into the loan file. We need to verify the completeness and accuracy of the application. But more importantly, we audit the quality of the credit assessment. This revolves around the timeless principles of the 5 C's of credit. Character. How did the underwriter assess the borrower's reputation and willingness to pay? Was it just a credit score, or were other checks performed? Capacity. This is crucial. Did the underwriter properly calculate the borrower's ability to repay? For commercial loans, this means rigorously analyzing debt service coverage ratios, or DSCRS. For consumers, it's the debt-to-income ratio. We must reperform these calculations to ensure they are accurate and meet policy thresholds. Capital. How much skin in the game does the borrower have? A significant borrower investment aligns their interests with the lenders. Collateral. Was the collateral independently and competently appraised? We check the appraiser's qualifications, the methodology used, and ensure the loan-to-value, or LTV, ratio is within policy. We also verify that insurance is in place. Conditions. How was the purpose of the loan and the external economic environment considered? Once the assessment is complete, we look at the approval. Did it stay within the delegated approval authority? For committee approvals, are the minutes detailed, showing a robust discussion and challenge? And then the often overlooked but critical step, loan documentation. Our audit must confirm that the legal documents perfectly reflect the approved terms. Are all covenants included? Are security interests, like mortgages and liens, properly perfected and filed? A loan with weak documentation is like a house with no doors. It offers little protection when you need it most. A loan is not a set-it-and-forget-it transaction. The risk profile of a borrower can change at any time. This is where portfolio monitoring acts as the organization's radar system, scanning for storms on the horizon. Our audit here assesses whether this radar system is operational and effective. First, ongoing monitoring. For commercial loans, are financial covenants tracked and tested promptly? When a borrower submits their annual financials, is someone analyzing them and comparing them to the projections? We look for evidence of this ongoing diligence. Second, risk rating accuracy. Is there a process to ensure a borrower's risk rating is updated when new information arrives? We often test a sample of loans to see if their current risk rating aligns with their actual financial health. We also analyze rating migration to see if the portfolio is silently deteriorating. Third, early warning systems. Does the institution have defined triggers, like a missed payment, a broken covenant, or negative news, that automatically flag a loan for special review? We test these triggers to see if they are working and if the resulting actions are timely and appropriate. And fourth, concentrations. This is a portfolio-level risk. Is the institution overexposed to one industry, like commercial real estate, or one geographic region? We audit the process for identifying, measuring, and managing these concentrations against the board's risk appetite. Are concentration limits being breached? Despite the best underwriting and monitoring, some loans will become problematic. How the institution manages this process determines the ultimate loss it will take. Our audit here is about rigor, timeliness, and recovery maximization. First, and highly technical, is impairment under IFRS 9, or CECL. The audit must verify that the process for identifying credits that have significantly increased in credit risk, what IFRS 9 calls Stage 2, is robust. We test the methodology for calculating expected credit losses, or ECL. This is not just about the loans that have already defaulted, but those that are likely to. The integrity of the financial statements depends on this. Second, the workout process. Are problem credits promptly transferred to a specialized workout unit? Once there, is there a documented strategy for each credit, whether it's restructuring, forbearance, or legal action? We review these strategies for appropriateness and track their success rates. Finally, collateral realization and charge-offs. When all else fails, the institution must foreclose and sell the collateral. We assess whether this process is efficient and designed to maximize recovery, and are charge-offs and write-offs handled according to policy with proper authorization. This is a key fraud control point. As we bring our session to a close, let's summarize the key takeaways for auditing credit risk. 1. Start at the top. Never begin an audit in the loan files. First, understand the governance, the risk appetite, and the tone set by senior management. A weak foundation makes everything else risky. 2. Follow the life cycle. Your audit plan should mirror the credit life cycle, from origination to monitoring to workout. This ensures complete coverage. 3. Test the controls, not just the compliance. Don't just check if a policy exists. Test if the controls within that policy are operating effectively. Re-perform a DSCR calculation. Trace a covenant to its monitoring report. Verify a collateral filing. 4. Data and models are key enablers. Pay close attention to the quality of data and the validity of the models that drive decisions and reporting. And 5. Your role is strategic. A strong credit risk audit doesn't just find past errors. It provides assurance on the future resilience of the institution's largest asset base, its loan portfolio. Thank you for your time and attention today. I hope this overview has provided you with a practical and strategic framework for your next credit risk audit. The goal is to move from being a simple checker to a valued advisor who helps safeguard the organization's core. If you found this video as useful, please do share it with your friends, colleagues, and feel free to subscribe this channel. Thank you again, and have a great day ahead.